Ladies and gentlemen, welcome. It is time for another Foundations of Stocks and Options tonight. I am so looking forward to tonight's class. I'm looking forward to it because I feel like tonight you guys are going to get a fantastic discussion on option pricing. And as far as I'm concerned, this is the best slideshow and presentation on option pricing I've ever put together, and I'm very excited to bring it to you. It is my hope, it is my desire, it is my wish, it is my plan that by the end of the evening, every one of you will understand options pricing in a way that you have never understood it before. And you will all send me love email telling me how much you appreciate all the hard work I did putting this fantastic class together for you. That is just my humble desire. Now, we'll see what really happens. But anyway, here's our agenda for the night. We're going to take a look at option chains and standardizations of options. We kind of started talking about some of that last class, but I'm going to really dig into some of that tonight. We're going to talk about option pricing, as I mentioned, which is really going to get into some great detail. And then we're going to talk about how option pricing works with stock moves. And we're going to do a lot of what's the word? Examples, calculations is the word I'm looking for. All right. So here we go. Let's get the party started. I do want to kind of give you a slight warning. Tonight is kind of some of the boring stuff. Most of the time we like to focus on the cool stuff, the stuff where you can see how much money you can make, but sometimes we have to deal with the boring stuff. So tonight's kind of some of the boring stuff. Hopefully it won't be too boring, and most importantly, now that you see all the cool stuff and how you can make money, it makes the boring stuff a little bit easier to digest because you realize you're working towards something, right? So here we go. Option chains and standards. Let's get into this discussion. Just really fast, couple slide reviews. Definition of options. A stock option is when the buyer of an option has the right but not the obligation to buy or sell a specific stock at a specific price on or before a specific date. That is the definition of the option. I'm always going to keep throwing that in front of you because I never want you to forget that definition. There's two types of options. We got calls and puts. Always remember, calls are the right to buy. Puts are the right to sell a stock. All right? Call options and put options. The call is the right to buy. The put's the right to sell. And, of course, there's always two positions. There's always a buyer and a seller. The buyer of the option receives all the rights. The seller of the option has all the obligations. So, in total, that becomes 4 trades. You can buy a call, sell a call, buy a put, sell a put. The call option, again, is the right to buy a stock. So, if you buy a call, you've purchased the right to buy the stock. If you sell a call, you've sold that right. You've become obligated. Okay, and the put being the right to sell the stock. If you buy the put, you have the right to sell. If you sell the put, you've become obligated to purchase it. Okay, somebody else has the right to sell. Who are they going to sell it to? They're going to sell it to you because you sold them the right to do so. Okay, those are your basics. Now, tonight, these are still basics, but this is getting to the stuff that makes a lot of people's brains hurt. We mentioned in the last class that exchanges bring in standardizations into the world of options trading. And this is really the biggest reason that we actually have the world of options is because exchanges make it possible for us. And conversely, the reason that we have exchanges is because it makes it possible for us to participate in this market of options trading. A lot of times exchanges are painted out to be the bad person. When you deal with finances, you're always dealing with the possibility of losing money. And inevitably, when someone loses money, they're going to blame somebody. And who do you blame? Well, anybody but you. And of course, you guys know that my personal opinion is if you lose money, it's no one's fault but your own. And so the exchanges make the marketplace happen for us. It's where all the market makers do their business. And then you have the clearinghouse. The exchange sets up the regulations and the standards, and then the clearinghouse actually facilitates and guarantees the trade. And then what that allows us to do is Jeannie can come into the market, and she can buy some options, and David can buy some, and Thomas can sell them. And it doesn't matter. They don't have to match up with each other. They don't know who else the other part is. And so as far as we're concerned, the exchange is the other party, and the exchange is going out and finding the other buyers and the sellers. All right? So as we deal with exchanges, what exchanges did when they came along is they set standards that we could abide by in terms of options. And we're going to go through a lot of those standards tonight. Since we have standards because of the exchanges, what that allows us to do is rather than having these odd contracts, for example, before exchanges came along, Scott might show up and say, hey, I've got 9 shares of this stock. We'll make something up here. I got 9 shares of General Motors, and I'm afraid that it's going to go down. I want to buy some puts on it. And so maybe I would meet up with with Scott, and we'd meet in Vegas, and I'd say, hey, Scott, I'll take that risk for you. You pay me a little premium here, and in the event that General Motors goes down, hey, I'll take that stock off your hands. I'll pay you this guaranteed price. Okay, so I would have just sold Scott a put for $9 or for nine shares. And you know what the strike price had been? Well, I don't know. We make one up. Maybe it was 43.21. You know, you can make up an odd strike price if it's a personal contract between two parties. But when you're having contracts that are being traded and they need to go between multiple parties and they need to have, you know, systemizations to them, that's where we have to have standards. And that's what the exchanges do. They establish standards for us. The CBOE, Chicago Board of Option Exchange, is where all options trading standards come from. You can visit them at cboe.com. In fact, it's not probably a bad idea for you to bookmark their website and, you know, just have it available. I don't spend a whole lot of time on their site, but you can find all sorts of interesting stuff on there, especially as far as regulations and, you know, that kind of stuff. So if you ever want to just have another resource, cboe.com is a great place to have bookmarked in your browser, and you can always go over there and find a bunch more nerdy information. All right, so standards are set by CBOE, and what the Chicago board does is they've determined the products, as they would call it. So you have index options, you have equity options, you have all sorts of various products that CBOE actually provides to the marketplace. In fact, the whole ETF market is actually another separate product. It's not really considered an equities product. It's an exchange traded product. So anyway, they've got all sorts of different products that are available, and they're all traded through the exchange here. Now, what the exchange is going to do from a functional standpoint is facilitate the trade. But from a practical standpoint, in order to facilitate that trade, what they do is they set up these standardizations so that whenever Chris comes to the market, he knows that Alex is also dealing with the same number of number of shares, number of strike prices, and everything else. So everything becomes standardized. Now, here's the key standardizations that CBOE brings to the table, and things that we're going to dig into tonight. Number one, contract size. Contract size is very important. Instead of having, you know, an odd number, you know, for example, 9 shares or 98 shares, instead of having that, CBOE has standardized it and says it's always going to be 100 shares, and that's what a contract is going to be made up of. We're going to have strike prices that are standardized, so you can't have these awkward strike prices at 43.22. It's always going to be a standard strike price. We'll talk about that. And then you're always going to have a standard expiration. You can't just randomly have this expire on the first of the month. That's not when expiration comes. So expiration is going to come on a specific date, and those are standardized by CBOE. So let's break each of these areas down. Contract sizes. I've already mentioned this to you a bajillion times, but I'm going to say it again because it's still kind of a new concept to some of you. Options trade in contracts. Whenever you trade an option, you are not trading an equity. You're not trading a share of a company. You're trading a contract. Literally, it's a contract. What kind of a contract is it? Well, we call it an option contract, but functionally speaking, as we saw in the last class, an option contract is nothing more than a contract to offset risk. It's a hedging tool. It's an instrument that we can hedge our positions with. And so if we were dealing with an insurance policy, let me just use an example here. Let's say that you have a house, and your house was a nice house that you really enjoyed living in until one day a fire came and burned your house down, and your house was all up in flames. And this is my flaming artwork. Fantastic, right? So let's say your house was originally worth $300,000, and unfortunately, after the fire, your house is worth the property, and that's it. And your property is only worth $50,000, okay? Well, overshadowing this entire house, you had a insurance policy. Okay, and let's say your house was paid for. Okay, and so your insurance policy insured the entire value of your house for $300,000 plus the contents and everything else. Now, let's say that you paid $2,500 for the year for your insurance policy. That was worth $2,500 at the beginning of the year, assuming that the house continued to stand. By the end of the year, it wouldn't be worth anything. But what happens to your insurance policy's value if your house is suddenly devalued to $50,000? Well, that insurance policy is going to be worth the difference of $250,000. How do I get that number? Well, your house was worth $300,000, and you have the right, I'm going to write that over here, you have the right to receive that much money from your insurance company the difference, I should say, of the equity that you have remaining, $50,000, versus your full amount of $300,000. You have the right to receive that from your insurance company. So this insurance contract has suddenly become worth $250,000 to you. Do you see how that would work? $250,000 is suddenly a whole lot more than $2,500. And now you understand why you buy insurance for your house. It's an investment, literally. Well, options are no different. Options are an insurance policy, functionally speaking, for your stock. And it allows you to offset risk, as we looked at in great detail in the last class. Well, those options are going to trade in contracts, and those contracts are going to be made up of 100 shares of stock. Okay, this is literally a legally binding contract. If you were to ever, let's say you sold a put option, and then the stock that you sold that option on were to go down to zero, or maybe the company went bankrupt and someone said, hey, you have to buy my shares at this price. And if you were to try to not do that, they would come after you and they would have a legal right to acquire that money from you. You would be obligated because you literally signed a contract. Now you say, I didn't sign a contract, I placed a trade. Well, you didn't sign a contract for placing the trade, but you signed an overarching contract when you signed up with your broker. When you signed up with your broker and all that disclaimers and all those contracts that you signed and you said, yes, I agree, and you initialed here and you gave them all your personal information, your firstborn and, you know, your DNA and your blood type and everything else that they asked for when you signed up for a brokerage. Whenever you signed all that paperwork, you agreed to these contractual terms. So whenever you place a contractual trade, let's say you buy, or let's say you sell 10 contracts of Apple, and that's 1,000 shares of Apple, right? So if Apple were to go down from $700 to nothing today, you know, you would be on the line for $700 a share times 7,000 shares. Oops, that's $700,000. And you're like pooping your pants and you say, oh, I'm going to run off to Mexico. Well, they're going to come after you because you literally agreed to that contract. And that's literally when you're trading an option, that's what you're trading. You're trading that contract back and forth, just as though it was an insurance contract for your insurance policy for your house. Well, this is an insurance policy for your stock. Okay. Of course, the call option is that contract for the right to buy the stock, and the put option is the contract for the right to sell a stock. So you need to always remember, whenever you trade one contract, it equals 100 shares of stock. Now that gets a little bit confusing because contracts are priced in shares, but it makes sense when you get to the bottom of it because you realize, oh, I don't really want to have to think through this and reverse engineer it to figure out the price. It's better to deal with the per share price for the contract and then always multiply by 100. Okay, so that's what you're going to be doing when you are trading your options. Now let's talk about strike prices. First level standardization is your contract prices, or your contract size, I should say. Strike prices. Odd strike prices are impractical. If we were to, let's say, you know, Apple traded at one point today at $702.11. Let's say if you wanted to sell somebody, or somebody wanted to buy a put option at $702.11. Okay, well, $702.11 might make sense to the person who had just purchased the stock at $702.11, but it wouldn't make sense for the exchange. So you would not have a whole lot of interest in a $702.11 strike price. Doesn't make sense. So what the CBOE does is they standardize your strike prices so that the market becomes more manageable. Now we can just simply say, hey, we're trading a $700 call, we're trading a $700 put, or we're trading a $50 call, we're trading a $50 put. And so you have a nice round number that everybody can agree on and everybody can deal with. So that means when you're hedging your positions, you don't hedge it to the penny necessarily, but at least you can be somewhere in the vicinity of it with your strike price, and then the difference, that becomes part of your risk that you're taking on. All right, here's the standard strike prices as a whole. Generally speaking, stocks that are less than $5 are not optionable, so you don't have to mess with those. Stocks that are trading in a price range of $5 to $25. These are, generally speaking, going to have strike prices in a 250 increment. So, for example, you would have a $5 strike price, a $7.50 strike price, a $10 strike price, $12.50, all the way up to $25, okay? Now, when you get to 25, the strike prices change, and you go from 25 to 30, 35 to 40. That's because stocks that are trading with a strike price range between 25 and 200 are going to have strikes in increments of $5 Okay, so $5 increments. So you'll have a $25 strike, 30, 35, 40, 190, all the way up to 200. Okay, then when you get to 200, we have another shift. We go from 200 all the way up. We start having $10 strike prices. So you go 200, 210, 220, all the way up. So if you look at a $600 stock, most of the time it's going to be 600, 610, 620, 630, all the way on up and all the way back down, 590, 580, etc. So this is the way that your standard strike prices are. Now, I call them standard because for whatever reason, there are some non-standardizations. And here's the funny thing about it. If you go to cboe.com right now, you can look it up, and you have to dig for it for a while. But if you dug deep enough and you found the document on strike prices, they actually say that their strike prices are for $5 or $2.50 or $5 or $10 increments. However, what started happening several years ago, and it always seems like it was last year, but it was about 3 or 4 years ago now, we started seeing $1 strike prices. And it started off with just a few stocks, if I remember, Starbucks and Microsoft were some of the first ones to come to market with $1 strike increments. And then we started seeing more and more. And now I think, as far as I know, almost all of the NASDAQ 100 have $1 increments, at least in the cheaper price range. What's the standard for it? I don't know, because I never have figured out who gets the $1 increments and who doesn't. I just know sometimes I pull up an option chain and the stock has $1 increments, and sometimes I pull them up and they don't. And so I don't really worry about how they decide it. I just know that when I sign in and I look at the option chain, if they're there, then they're available and I can trade them. The interesting thing also is when you get to really expensive stocks, the $600, $700 stocks like Apple, for example, $10 is the standard strike. And so for the most part, you go through $100 stock, $200 or more stock, and you'll have $10 strike prices. Apple used to be that way, and just in the last several months, they started issuing $5 increments. So right now on Apple, you can buy a 700, you can buy a 705 call, a 710, 715, you can buy 695, you can buy 690, 685. And so we've got these $5 increments. The only explanation I have is that when you get to a position where there's enough volume and you have enough interest in those additional strike prices, that's when CBOE is issuing them and saying, okay, well, we'll go ahead and approve these to be issued in these lower, smaller increments. And so it's an exception. It's not the rule, but there are becoming more and more exceptions. Most of the exchange-traded funds that you're going to trade, especially the ones we talk about, because I only talk about really heavily traded ETFs. That's the only ones I look at, really. But, for example, the QQQ, trade the QQQ, the spiders, SPY. If you look at the diamonds for the Dow Jones, DIA, you look at the inverse funds. For example, SPY is an inverse fund for the spider, for the S&P 500. You look at these heavily traded, exchange-traded funds, and they are almost all going to have $1 increments. Almost all of them. And now, and this is like brand new. I mean, this is in the last, I think, maybe like 3 months. It's been very, very recent. We've started seeing some 50-cent increments. Silver is the first one that I noticed it on. That's on an ETF. And then just last month, I started noticing that they've showed up on the QQQ. In fact, right now, it's for September. You've got 50-cent increments at where are we at? 70.50, I think it is. There's a 70.50 strike price. And so you've got these awkward increments, and you say, well, why are they there? I don't know. It really doesn't matter. They're available. And so the bottom line is, if the strike price is available, then you can trade it. I've told you the standard, so you know what the standard framework is, but bottom line is this: if it's available, then you can trade it. There are other issues. I didn't put it in my slides, but I'll just tell you, there's other things that can affect your strike prices as well in terms of having awkward increments. It used to be the only thing that would affect and give us weird strike prices were stock splits. And so, for example, if you had a stock that was trading at 66.50 and then they split the stock by a factor of 3 to 1, well, that stock has just become worth 22, and then whatever 3 into 50 is. I should have used 666. Yeah. Then your stock has become 22.22, right? It's because of the 3 to 1, but you have 3 times as many. Well, those options that were trading at like $65, they just got split at a 3 to 1 ratio as well, and that could create some really funky strike prices. Again, the rule of thumb is very simple. If the strike price is available, you can trade it. And so you don't really have to sit here and twiddle your thumbs and try to figure out, all the details. I've given you the structure, but if it's available, you can trade it. You pull up your option chain. If it's there, feel free to do it. All right. So there's your strike price discussion. Now, let's talk about option chains. If you come over here to your option chain, you're going to see all your strike prices listed right down the middle. Now, I've only put half of the chain in here, but those are your strikes right down the middle here. These option chains, I've already introduced you to this back in level 1, but I'm going to go in much more detail tonight. These chains are going to have all your key information you need. For example, your strike prices. Whatever available strike prices are available, you will see it in the option chain. Your bid and your ask, your quotes, in other words, those are going to be available in your option chain. You're going to see your available expiration months. You're going to be able to see your Greeks. Basically, everything you need to know about your options will be right here in the option chain. So let's zoom in on this chain here and look right down the middle. These are the expirations, or not the expirations, sorry, the strikes available for the spiders for November. Okay, so you can see here we've got 142, 143, 44, 5, 6, 7, 8, all these $1 strike increments. Okay, that's because the spiders, even though we're trading in the 142 range, they're an ETF that has $1 increments. Okay, so again, if it's available, feel free to trade it. In fact, I really like these that have just $1 because it allows you to just buy a little bit in the money, and you don't have to go necessarily $5 or $6 sometimes. It really makes them very affordable and a lot of flexibility with these $1 strike prices. So I really like them a lot, to be completely honest. Anyway, this is a kind of a minimalistic option chain here. Very standard. I've used all these screenshots from Options House, but every broker is going to be pretty similar. Okay, so I'm going to teach you the basics here, and then you can apply it to your brokerage, whoever you're working with. Right down the middle of your option chain, you're going to have your strike prices that we talked about there. Somewhere in here, usually right above it, you'll have the expiration month. Options Express puts it over here on the right and on the left. Okay, and then they have the months up top that you can click through. This is the way Options House does it, and I actually kind of like this format a little bit better. Anyway, so you've got your expiration month, then you're going to have your bid and your ask, your last. This POS is for position. And then you have your puts on the right. So you have the calls on the left, puts on the right, bid, ask, and last. This is very minimal. This is the absolute bare bones. I mean, this is the kind of stuff you get from free software. More complex, this is a very advanced chain. Take a look at this one here. This one here, you got the bid, the ask, the change, the bid size, the ask size, implied volatility, delta, theta, vega, volume, open interest, and your position size. Then you've got the strike prices down the middle, and it all repeats over here for your puts. So you can be very minimalistic with an option chain, and you can be very detailed with an option chain. Do you need to always look at this much information? Probably not. A chain that I work with a lot is this particular picture right here. I also sometimes like to add my delta into this view right here. So take a look at this one here. What you've got is you got bid, ask, last, change, volume, and open interest. These are really the keys that you're going to be looking at. And of course, delta would be nice to add in there. Although I have a pretty good understanding of option pricing, so I don't always look at delta. Because if you follow the rules that I give you, you should have a decent delta, which we'll be talking about here in the next 15 or 20 minutes. All right, so this is kind of a basic chain. Again, this is about the size I like to look at. I don't like to look at all the numbers. I feel like it's overwhelming, and you know, that's just the way I feel about it. Okay, so let's break all these components down. I already see questions coming in. You're assuming I'm not going to tell you. So here we go. Here's your components. The bid and the ask. The bid is the offering price. This is the price that if you're selling, you will end up selling at this price. So if we look at a 138 call option and you're wanting to sell it, well, that's currently fetching $2.15 according to this option chain right here. That's the bid price. This is where you're selling. Okay, now if you're buying, you always are paying the asking price. That's the ask. So the current buy or the current selling price, the price that you would pay if you're buying, is $2.18 according to this option chain right here. Now, some of you might say, well, I'm not willing to pay $2.18. I'm only willing to pay $2.15. Well, if you did a market order, you will pay the ask price, period. No ifs, ands, or buts. If you do a limit order, you specify the price. So you could do a limit order and say, I'm only willing to pay $2.16. And then the market maker looks at it and says, well, I don't have anybody here at 216. I've got some people that'd be willing to sell at 216, but no one, I'm not willing I got some people willing to buy at 216, but in order to get my spread, I can't make that thing work. So you're going to have to wait, and then as the market trades down a little bit, eventually you'll get filled when they can match and they can get an ask for the 216 price. Does that make sense? So in other words, what the market maker is doing is they have that little bit of room right there. In this case, it's 3 cents. A lot of times it's 1 penny. Especially on very heavily traded issues, you'll have a spread of a penny or 2. In this case, it's 3, which is a pretty tight spread. I have seen spreads where you'll have 50 cents or $1.50, and those are the ones where it makes sense to do a limit order and try to go in the middle of the spread. But when you're dealing with very heavily traded issues like the spiders here, I mean, look over here at the right side, the puts, you got a 1 penny spread on the bid and the ask. Well, why would you ask the market maker to sacrifice? He can't even have a penny to work with. That spread, that is literally the leg room. That's the flexibility that the market maker has to break even or make a profit. Okay, and so that's the difference right there. Somebody says, what do you mean by the spread? Jake, it's this right here. It's if your bid is 181 and your ask is 182, well, there's a 1 penny difference right in there. And that is the spread. It's the difference between 181 and 182. This spread is the amount of money that the market maker has to work with. So if they sell it to you for 182, you will assume you are the buyer. If they sell it to you for 182 and they're buying it from the seller at 181, so this goes to them, the seller, okay? Then the market maker has a 1 penny profit, or we'll call it the spread because they may not actually have a profit on it, to be completely honest, but that's their working spread. That's what they have to work with, okay? So, I never get upset about tight spreads. If I see a large spread, if it gets over 25 cents, or certainly if it's over 50 cents, then I start, putting limit orders in, and I'll try to go in the middle of the spread. If I'm dealing with something like the spiders and I see a 2 or 3 penny spread, I am not going to make a big deal about it. I'm totally fine with letting the market maker take a little bit of money for themselves because, after all, they are making the market for us, all right? Also, one of the things you're going to find with these spreads, just this is kind of an FYI, but the spreads will widen with more volatility. So if you launch your option chain first thing in the morning, right as the market is opening, and you see an influx of orders come in, you'll see these spreads separate as the market makers are trying to cover themselves to make sure that they can match the buyers and sellers, because these orders come in very, very fast. I mean, literally thousands of them at a time. And so the market makers are widening and tightening their spreads to try to provide a competitive market, but at the same time not lose money matching the market. So when you have high volatility, let's say that Ben Bernanke is speaking, and we know that he's going to either announce or not announce the new quantitative easing. Well, that creates a lot of volatility, a lot of instability. So the market maker has to widen the spread to make sure that they've covered their positions. And yes, the market makers can lose money, because let's imagine for a moment, if you issue a market order, let's say you put in a market order, and that market maker says, okay, I've got somebody who's willing to buy, let's say it's a market order to buy 10 contracts at market, but with a 138 put, okay? It's a market order. So you're saying, I'm willing to pay 182. I'm willing to pay 182. Well, that market maker looks at it and says, okay, I got a buyer. I'm going to take the buyer. And they may sometimes take a buyer before they had a seller. And then they're thinking they can sell it at 181, and it turned out that their seller really was stuck on 182 and they never could find the seller there. So the market maker sometimes breaks even, or they may not make a profit on it at all if the bid and the ask are too tight, and if they can't actually make the market, because the market maker literally is the other half of your position as far as you're concerned. Okay, the other side of it. People often say, well, who's going to buy it from me? Well, the market maker. Now, if you do a limit price, there's a good chance, when I say there's a good chance, there is a chance you will not be filled. If you do a market order, there's a very high probability you will be filled. They're not guaranteed to fill it at a market price, but there's a high probability that if no one else steps up, the market maker will take the risk all for themselves, and they will find a buyer or seller at some other point in time. So the market maker really is the person that's making the whole thing happen. Okay? Hopefully that was educational and it made sense to all of you. Now let's talk about the last price. Moving from left to right, bid and the ask. Bid is the selling price, ask is the buying price. The last price is going to be the last price that the option traded. So let's take a look, just picking out some of these various options in here. Looking at the 138 call option, the bid is at 215, the ask is at 218, the last price was 218. So the last person to actually buy it had paid 218. Okay. Now, if you come on up, let's just pick another strike in here. 135. Sorry, that's not the one I want. Let's do 134. The 134 has got a 501 bid and a 505 ask. You got a 4-cent spread in there. Looky here, the last price was at 502. So sometimes, not sometimes, all the time, the bid and the ask are changing, but if there's not actually a transaction at that price, then the last price will reveal something different. And sometimes this can actually confuse you guys. Sometimes the bid and the ask are way higher and the last price is way lower, and you look at your position and you say, well, the ask is way up here. Why is my account not show that I have more equity in it? Well, it may be because your account's just revealing what your last price was. Most of the time your account values change based on what the last price actually was. Okay, and so you can always look in here and see what the last price was, and then the change, which is the next column, this is the difference in the last price, which was just transacted, and yesterday's closing price. So let's say that the 137 put option closed yesterday at well, I will tell you where it closed. It was up 16 cents from where we are, so it was approximately 160. All right, so yesterday, at the end of day yesterday, yesterday's last price, also known as the closing price, was $1.60 per share. Well, right now, the current bid and ask is 143 by 144. Well, the last price for this was 144. So you take out the last price, the current last price, and that leaves you with 16 cents. That is the difference. This last price is down 16 cents from yesterday's close. That's what the change reflects. And whenever you look at your balance sheets at the end of the day and your trading account, and you're going to see the change in your option, it's going to say up or down, and it'll give you an amount. That's based on the change between yesterday's close and the current last price. So if you're looking after hours today, then you'll be seeing today's last price relative to yesterday's last price. But that's always the way that we measure the change in either a stock or an option or anything else. We always are comparing the last price relative to yesterday's close. Okay? Now, the next column in here is the volume. Volume is simply put the number of contracts that are trading today, that have traded today. It's volume. It's just the amount that traded. Okay, so if you look on here, you can see that the 137 had 3,457 that traded. The 138 had 17,417. One of these was more active. The 139 had 4,736. But look here, the 140, wow, 32,000. So we had very heavy volume interest at the 138 and the 140 strike price and the 141 and 142. Look at all these volumes here. But it turns out that the 137 calls were not that popular, and 1,300 volume for the 136, 208, at 135. Very, very low volume proportionally for these deeper in the money call options. Okay, now come over to your put options, and you're going to see the exact opposite will be happening. These higher strike prices, 143, very low volume. 84. We actually had pretty decent volume, 6,818 for the 142 puts. But you come up to the 138, you've got 25,813, 35,000, 44,000. So you see where the interest is. We've got a lot of volume surrounding certain strike prices, okay? That's what volume is. Again, volume is the number of contracts today. It is today. Now you compare that with open interest. What is open interest? Oi. For those of you familiar with the language of Portuguese, oi means hi. In option trading, oi means option open interest, all right? Open interest is the number of contracts currently open. There's a difference in volume and open interest. Volume is the number of contracts traded today. Open interest is the number of contracts currently open. Now, understand the difference in the equity market and the option market. In the world of stocks, we have a certain number of stock that have been issued for a company. We call it outstanding shares. Okay? So if a company has issued 1 million shares, they have 1 million shares that can be traded. That's the interest or the outstanding shares for that company. In the world of options, we don't issue options. Options have to be written. They have to be created by traders like you. And so let's say that Oscar comes into the market and Oscar says, I want to sell some new positions. I want to sell some August 140 puts. Okay, so Oscar comes in and he sells some August 140 puts. He brings in $2.80. He has just written a new contract. Okay, literally that's what happens. Remember, we're trading contracts here. We're not trading shares. We're trading contracts. And so whenever Oscar comes in, he says, I'm going to enter an order that is a sell to open. He is writing a new contract. That adds to the open interest. When a trader opens a new contract, it adds to the open interest. Whenever a trader closes a new contract, it reduces the open interest. Open interest is not a measurement. Again, I'll say it. It's not a measurement of buying and closing. It is a measurement of open contracts on the market. The number of open contracts on the market. Okay, so that's what open interest is. Some people, one of our students actually described it as inventory. How many are available? I think an easier connection for most traders is outstanding shares. It's the option version of outstanding shares. But the thing is, open interest changes constantly. Unlike outstanding shares don't change every 5 minutes. Open interest does. If you sit here and you watch an option chain during the day, notice the differences here. The 138 has 118,000 open interest. 139 is 117,000. Look at the 140, 194,000. Now come over here to these puts. You've got 127,000. Look up here, the 133 puts, 290,000 open interest. Well, I can tell you that there's a lot more people that are hedging their put bets right now because there's 290,000 open interest. That's a lot more. That's 2 to 1 the number of open interest versus people that are betting on out of the money call options. You've only got 68 and 99,000 the 143 and 142 calls. Okay, so that means that there's more than 2 to 1, almost 3 to 1 puts to calls. We would call that your put call ratio. Okay, that means there's more people that are hedging their downside risk than there are people that are either hedging their upside risk or buying speculative call options for a bullish trade on the spiders, at least based on this particular screenshot. Okay, does that make sense? So, Willie says open interest makes the price of the option go up. No, open interest does not make the price of the option go up. Open interest simply is a measurement of how many people have open positions. That's it. So then let's say that today, right now, let's suggest that the 138 has 127,000 that are open positions. Well, as the stock were to go down, let's say that the spiders were to start going down, and people who maybe had purchased a little higher, they start to have a profit in this option. They're going to start selling them, closing their positions. And as you look here, these strikes have a lot lower open interest because people are not hedging those positions as much like they were. They're closing them out. So the further in the money you get, the more closed positions you tend to get here. Makes sense? Now, here's what it really means, and here's the reason we care the most about it. Open interest is a measurement of liquidity. If you have an option and it's got an open interest of, say, 50, and then you decide you're going to buy 20 options, you control almost half of the entire market. You see what I'm saying? Open interest measures liquidity. It's very important for you to understand that if you do not have good open interest, you will not have liquidity. So they'll let you buy the option, but then you go back to sell it and there's no market. Nobody wants to buy it from you. I remember with a student a few years ago, sweet girl, messed up her trade really bad. She bought some leap options on a stock, and she bought like 5 or 10 contracts. I can't remember how many she bought, but she bought leap options way out in the future, and the stock had moved in her favor. She had a profit, and she had an order to sell her leap options, and she had it set on her books for 3 or 4 days, and nobody would buy it, and she couldn't figure out why. And so I took a look at it, and I pulled up the chain with her. And when we looked at the option chain, remember I said she had either 5 or 10 contracts? That was the open interest. She literally controlled 100% of the market. She was the market. There was no liquidity. So she was able to buy it. She technically had a profit, but nobody wanted to buy the option from her because there was no market for it. So open interest reveals, more than anything, liquidity. Now, there is something, I just alluded to it, called the put-call ratio, which is simply the relationship between how many puts are in open interest versus how many calls are in open interest. A lot of people used to use that as a sentiment indicator. It really is not a great sentiment indicator. Sometimes you can, if you suddenly see an influx of put open interest opening up, then you know that there's a lot of people hedging for a downside turn. But by the very nature of a put, understand that the majority of market participants are in long equity positions. The majority of market participants buy stock long. So what is the natural option trade? The natural option trade is to buy puts because the majority of market participants are buying protection or a hedge for those positions, for those long positions. So after a big market move like what we had last week, and then the market runs up really fast, a lot of funds in particular, funds will do this, especially hedge funds. They will try to lock in their profits. Rather than putting stops in, they'll put puts in place. Okay, and so a lot of this open interest is hedge fund puts. And then if the stock keeps running up, then they waste that money and they don't care because they're building equity. But if the market does not keep running up, if it runs down, then they've hedged their position and they sell the put and hold the equity. That's the strategy. And so a lot of the put open interest you see is hedge funds that are simply hedging their position, and it really says nothing about overall market sentiment. Sometimes, again, you will see a little bit of sentiment revealed through the open interest, what we call the put-call ratio, but generally speaking, it is not a sentiment indicator that I personally look at. I don't think that you're going to really find a whole lot of value in it necessarily. All right, that's all I need to say about that. Are there any questions about option chains up until now? Any questions up until now, what we've talked about thus far, that I need to discover or I need to address? Okay. CB says that Schaefer's research projects option positions for 4 or 5 months out. I think it has something to do with put-call ratios. Am I correct? I'm actually not sure because I don't read Schaefer's report, but it would make sense for Bernie to do that. Bernie's an old-school option trader, and he really buys into a lot of the older school philosophies on it, and nothing specifically wrong with it, but in my opinion, it doesn't work as well as it used to. And you'll find this from a lot of option traders. In fact, a lot of hedge funds in particular a lot of hedge fund managers, I should say, are very outspoken that you can't pay attention to the put-call ratio like you used to. It used to be a great indicator, but as options trading has become more popular, and it is a exponentially growing market, by the way, but as options trading has become more popular, the put-call ratio as a sentiment indicator has broken down substantially. Okay? Rob says bid ask size question mark. Rob, the bid ask size is simply how many bids there are, how many people are bidding at that price versus how many. It's an internal metric that market makers are using. Let's say you have 500 asks and you only have 300 bids. Well, the market maker's got to match those people. And so market maker is always working to match the bid and the ask so that they can complete the transaction and make the trade actually work. Okay, that's what the bid-ask size has to do with. Okay, all right, let's continue. Expiration. Expiration technically occurs on Saturday. It occurs on Saturday at noon. However, you cannot trade on Saturday, and we always refer to expiration as Friday, even though in pure technical terms, it's happening on Saturday. We always refer to expiration Friday, which is the day before expiration. That's the last day you can trade. So standard options are going to expire on the third Friday of the month. Doesn't matter what month it is. January, February, March, April. It's always the third Friday. So you can't sit here and say options expire on the 15th. They might expire on the 15th if the third Friday is a 15th. But if the third Friday of the month is the 19th is option expiration day. Does that make sense? It's always the third Friday of the month. So what you have to do is you have to look at your calendar and you say, where's my first Friday? Oh, it turns out the first of the month was Friday. Okay, 1 week from the first. Okay, there's the 8th. Okay, there's one more week. That's my expiration day right there. The third Friday. It's always the third Friday. That's your standard. Now, most options expire on the third Friday because most options are standard options. However, we've got this magical option called the weekly option. And weekly options are fairly new product that CBOE has brought to the market. And weekly options expire on a weekly basis. And so they're going to expire on the Friday of the week that they expire, whichever week that is. So you'll have week 1 option, you'll have week 2 weekly option, week 3 weekly option is always the standard option, and then week 4 weekly option. So I'll say it again, week 1, 2, and 4 become weekly options. Week 3 is always the standard option. Makes sense because standard options expire which Friday of the month? The third Friday, exactly. Chris says, so that's this Friday. You are correct, Chris. This Friday is the expiration for the month of September 2012. You're absolutely correct. All right, weekly options, again, expire on the Friday of their respective week. Now, let's talk about a couple variations. We've got something that we refer to as leaps. Leaps are simply a long-term option. I explain it this way. It's an option with a really, really long time to expiration. That's all a LEAPS option is. LEAPS, the term, L-E-A-P-S, is actually an acronym for long-term equity anticipation security. Now, I realize, as well as you realize, that patient is not a word. I mean, that's the stupidest acronym I've ever heard. It technically should be L-T-E-A-S. But L-T-E-A-S spelled a really funky word, and so they decided to make it L-E-A-P-S so that it would say leaps, because leaps made a whole lot of sense. A leap option, or a leaps option, because it's plural, it's not, there's not a singular and a plural. Singular leaps is a leaps, and it's because the S is the acronym. Okay, so it's a leaps. Long-term equity anticipation security. A leaps option is simply just a regular option that has at least 9 months to expiration. We usually refer to them as a year or more because most of the time those are the ones you look at when you're looking at leaps. But technically, it's 9 months or more to expiration is a leaps option. Okay. Then, whenever the leaps has less than 9 months, it becomes a regular option. So a lot of options, especially January options, a lot of January options in particular start off as a leaps option, and then they become a standard option. And then before you know it, they're front month, and then before you know it, they're the weekly, and then they expire. All right, so that's the way that the leaps work. Leaps expire, just like all standard options, on the third Friday of the month for whatever expiration month they have. So take a look here. If you look over here, you see December 2014. Well, that's more than a year in the future. That's more than 9 months in the future. That's a long time. That's going to be a leaps option, okay? Now, if you come down the chain a little bit, take a look. Actually, let me do this right here. That's what I wanted to do anyway. Take a look here. You see the September 2012. Well, that used to be a monthly option, but it is currently the weekly option because it expires in 2 days. So that's the weekly option right now. Now you come out, you have October 2012, November, December, and January. These are all less than 9 months. So these are the monthly options, okay? And inside this monthly option category, you've got front month, which is essentially the front month that you're dealing with. And then you've got next month, which is the month after front month. Does that make sense? So you've got your weekly. That's the one that's expiring this Friday. You've got your front month option, and then you've got your next month. Everything else are just regular standard monthly options until you get out at least 9 months. So starting here, that's March 2013 through December 2014. And the way you're going to see this listed is quarterly. You'll see quarterly options. You'll see the leaps options quarterly. Then you get down to monthlies and then weeklies as you get closer and closer to expiration. In other words, you cannot presently buy a June 2014 option for the spiders. It's not been issued. Make sense? However, you can buy June 2013 because it has been issued. And then as we get closer to 2014, the June 2013 options, 2014 options will become available. Does that make sense? In other words, the closer we get, the more options become available that we can work with. Make sense? Okay, so take a look here, and you're going to notice in this chain, I'm going to show you something different here. You're going to notice the 2014, let's look at the same strike price, 145 and 147. Well, I don't know why it's, oh, I see why. Never mind. Forgive me. I'm not seeing stuff clearly. 145 up here, and then the 145 here. The reason is there's not a 147 issued this far in the future. That's another point to bring up. When you're this far in the future, I mean, we're 821 days in the future. I mean, some people don't even know if the world's going to exist in 821 days. So they've only issued $5 increments, 20, 25, 30, 35, 40, 45, 50. Okay, as we get closer to expiration, you'll start to see the dollar increments. And right now, you see for these particular ones, we've got some 50-cent ones, 144.50, 155.50, 156.50. Again, it all comes down to what's available. If they're available, you can trade it. Okay, so let's look at the same strike price, 150. This is for the 150 spider that expires in 2 days versus the 145, I said 150, I meant 145, versus the 145 spider that expires in 821 days, both for the 145 strike price. Notice a substantial difference in price. Why? The reason is because of time. That's right. And now you really clearly see it. Now, people say, in fact, I've already seen someone in here say, I don't see the attraction of leaps. That came from Kevin. He says, what's the purpose of a leaps option? The price seems so high at the time you buy them. Well, Kevin, you're correct. It is an expensive option, relatively speaking. But Kevin, let's suggest that you're not looking at your options as a short-term trade. what if you were considering, Kevin, what if you were considering, we'll write this up here. What if you're considering buying spiders? How much would spiders cost you today, Kevin? Spiders right now would cost you, according to this this option chain here, about $147 a share. How do I know that? Because the at the money is coming in at 147. I don't see the exact quote on here, but it's about 147. Okay, so if you want to buy, Kevin, 1,000 shares of the spiders, how much will that cost you? That's going to cost you $147,000, Kevin. Kevin, do you have $147,000 that you would like to put into the spiders? Or, Kevin, let me ask a better question. Do you think if you invested $147,000 in the spiders, do you believe that within a year you would know if that trade was correct? I think you would know. Well, a year from right now would be September 2013. What if you purchased the right to have the spiders until December 2014? That's a long time in the future, isn't it? For $15. Now, if you want to buy 1,000 shares, it's going to cost you $15,780. Do you think the leverage of 1/10 almost, just a little bit more than 1/10, the price, would you be able to manage the trade better? Now, here's the question. Over the next 2 years, how far down could the spiders go? They could go down theoretically to zero. Some people think the world's going to end and it's going to go to zero. So you technically have $147,000 at risk. Now, how far down could your 145 leap go? But you only have $15,780 at risk. So the amount of capital you're putting on the line is substantially lower. Do you see the advantage there, Kevin? Does that make sense? Okay. Now, here's the issue that some people would come back with. Some people would come back and say, well, if I own the stock, I could write a covered call. And you're totally correct. If you own the stock, you could write a covered call. You can also write a covered call against a leaps option. Now, that's an advanced topic. I'm not going to get into it right now, but you could do it. So in other words, you have the same flexibility, or a lot of the same flexibility, I should say. It's not exactly the same, but you have a lot of the same flexibility doing the leaps position for a fraction of the investment. Now, someone else might come back and say, what if I did this on margin? Well, in that case, you could do this for 50%. So you cut 147,000 in half. And what is 147,000 divided by 2? I got to get my little calculator out here. It's too many big numbers for me. That's 73,500. But you're borrowing an additional 73,500 that you're going to be paying interest on. So, Kevin, it still makes sense, in my opinion. If you want to leverage a long-term position, it makes more sense to leverage it with a long-term equity anticipation security rather than an equity itself. Does this make sense, Kevin? I haven't seen any feedback from Kevin, so I have no idea if he's following. Oh, there's Kevin. He says he can see what I'm saying, but what if the bid drops $16 over the next couple of years? You're still losing a boatload. Well, Kevin, what if the bid of the spiders drops $16? Kevin, let me ask you a question. If the spiders move from 147 down $16, you will still have equity, but you'll be down to 131. How much have you lost per share?